All right. Now we are starting another question from Advanced Audit Assurance Kaplan Exam Kit, which is Winbury Company. So it is 1st July 2005. You are a manager in the audit department of Queen and Co., a firm of chartered certified accountants, and you are responsible for audit of Winbury and Co. Listed entity and an existing client of your firm. The company has a financial year ending 30th September 2005, and you are about to start planning this year's audit. Okay. The following exhibits available below provide information relevant to the question. Partners email and email which you have received from Olivia Figure, the audit engagement partner, meeting notes, notes of a meeting with Olivia Fig recently attended with the audit committee of Winbury Company, focusing on understanding the current operation and future strategy of the business. Uh, Notes of meeting which Olivia Fig recently attended with the audit committee of Winbury Co., focusing on understanding the current operation and future strategy of the business, financial information, selected financial as you can see, 40 marks are technical knowledge-based marks and 10 marks are related to professional marks, overall 50. Now, let's look at the first exhibit first. All right, now, so partners email now. Um, to audit manager, Oliver Figure audit engagement partner, Winbury company audit planning, date 1st July 2005. I attended a planning meeting last week with the finance director and a representative of the audit committee of Winbury company, at which we discussed business during the year and plans for the future. I have provided you with my notes from this meeting as well as some background information about the company from the permanent audit file. Based on the analysis I have done on this industry, it is appropriate for overall materiality to be based on profit before tax, and this is a key for focus for investors and providers of finance. Cool. Now, using the information provided in the exhibits, I require to prepare briefing notes for the on use in which you again evaluate the significant business risks facing the company, evaluate and prioritize significant risk of material misstatement to be considered in planning the audit for financial year ending 30th September X516 marks. Okay. You should not. You should refer to all exhibit when carrying out the requested risk evaluations. Okay. Design the principal audit procedure to be performed in respect of the classification of the investment in luxury pet supplies with reference to the data protection issue referred to in Exhibit 2, discuss Coins and Co's responsibilities in relation to the Winbury's compliance with laws and regulations. 7. Okay, cool. So, for Winbury Company is a listed company operating as a retailer in the online grocery market with one of the country. The company has a loyal and growing customer base who place orders via either the company website or on an application app, which can be installed on a computer, customer's mobile phone. Winbury Company fulfills grocery orders, delivering to customers. Uh, Homes via a fleet of company-owned refrigerated delivery vehicles. Winbury Company prides itself on having a market-leading inventory system, which ensures that customers can only order groceries which are currently available. This helps Winbury Company customers avoid the inconvenience of ordering unavailable items. A significant proportion of the groceries supplied by the Winbury Company are perishable products. Okay. The sale and storage of which is highly regulated through food safety regulations. Winbury Company employs experienced food and product technology professionals to ensure that the company complies with all food safety legislation. The directors of Winbury Company are pursuing ambitious expansion plans in order to establish a strong position in the home delivery grocery market and to explore business partnerships in associated markets. Okay. So far, we found out the business risk, highly regulated industry, right? So now Winbury Company is planning to expand into foreign country of Farland by setting up operations similar to its existing business. Farland uses the same currency as existing currency to cost 125 million. Winbury Company does not currently have the fund for this expansion itself, but it is an advanced negotiation with its current bankers who are keen to provide loan financing on the same basis and covenant as that the existing loan finance. The expansion is expected to occur in 2006. Another two business risk, business expansion plan is going on. right? And they're planning to be expanded in a uh, foreign country for which they are not familiar with the laws and regulation of the foreign country, their market and all. So there is a chance that the business, the expansion may not be successful. So this is a business risk. Another one, the loan for expansion. Again, they are taking the loan for expansion, and if the venture is not successful, they may their loan will be extended. There will be a loss, so they may struggle, right? Data protection issue 2 months ago, Winbury company suffered a cybersecurity attack in which the personal information credit card, according to a representative of the company's internal audit team had not properly asserted the cybersecurity risk, which is a requirement of data protection legislation. In the jurisdiction in which Winbury operates, the issue which led to a cybersecurity that has now been resolved. Winbury company did not make any reports of the breach to the regulators. So we have another. So for three, four, that protection issue, right? Issue the sensitive information about the customers has been leaked, the credit card details has been leaked, which can lead to the bad reputation for the company, and this can lead to the fine. This is a business risk in this regard, right? We'll look at it in detail. Now, groceries revenue is increasing 587, 358. Pet foods, this is a new thing. Total revenue operating profit is also increasing. Profit before tax 53. Okay. Assets have also increased now. Net asset has consolidated relating to the subsidiary health company. New thing, property, plant and equipment 67. Long-term borrowing 3. Now, groceries revenue includes revenue earned for a new initiative launched during the year by Winbury Company. This guarantees a weekly delivery slot for customers who sign up for a premium delivery pass. Okay. The premium delivery pass is an annual membership with a fee of $60. This fee is invoiced in advance and the revenue is recognized in full at the time of invoicing. So another, this is the audit risk completely according to IFRS 15 revenue and customer contracts. As the revenue cannot be recognized until or unless performance obligation is fulfilled, right? And what they are doing for the premium delivery costs, they are charging in full. Sorry. Yeah. Yeah. Now, fine. They are recognizing revenue regarding the premium delivery pass in full in advance. Well, as per the IFRS 15, we cannot recognize it until or unless the full revenue has been recognized, until or unless the performance application has been satisfied. In this case, the goods and deliveries throughout the year should have been delivered to the customer to recognize the revenue. Until or unless they have to recognize this as deferred revenue. So if this is not corrected, that means deferred revenue is understated and revenue is overstated. So The revenue. Next, Winbury Company has entered into a joint arrangement with Durian and Co. and is investing 13 million in a newly formed company, luxury pet supplies company, representing 50% of the share capital of the company. The remaining shareholding is owned by Durian Company, a leading national chain of pets and pet food goods. Okay. Supplies the contract behind this investment states that Winbury and Dairy Company will work together to develop the supply of a range of pet supplies, food, toys, and accessories. The joint venture agreement utilizes the established online presence of Winbury and their distribution network. Dairy Company existing knowledge of the pet food supplies market. Both parties will have equal voting rights and equal rights to the net assets of LPS company, with profit to be shared equally. The investment expected to take place in August X5. The finance director of Winbury Company plans to consolidate the results of LPS company as a subsidiary with a share of the result attributable to Durian Company being shown as non-NCI. 100% of LPS company's revenue from incorporation is shown separately in financial information. Above owning to the Winbury Company full compliance with IFRS 8 operating segment. The finance director believes despite Winbury Company and Durian Company each owning 50% of LPS company and having equal representation on the board of directors, Winbury Company contribution of knowledge to the joint venture is greater, and therefore Winbury Co. should consolidate the investment. Well, in this regard, they are uh, planning to consolidate the venture, although they are investing, the one is giving that, but the other is taking the of the resources for the distribution and all. But not be consolidated because either one of either control over the operations of another company. For example, either Benbury has the control of the Durian in decisions. I don't think so. So, in this regard, let's see. But in January 2005, there was a now in January 2005, there was a fire in one of the Winbury Company five warehouses, which completely once. Wait a minute. Oh, yeah, January. Okay. In January X5, there was a fire in one of Winbury Company five warehouses, which completely destroyed the premises, but unfortunately, no staff were injured. Okay. The warehouse service the northern region of Winbury Company customer base. The finance director has not written down the carrying amount of warehouse in property, plant, and equipment as he is confident the company's insurance policy will cover all. No matter what insurance amount will be received, they should have been written down. They should have tested it for the impairment. So if this is not done yet, the expenses are understated and the property, plant, and equipment values are overstated in this regard. Okay, the insurer then confirmed they will repay Winbury Company for the inventory loss during the fire. However, the claim for the warehouse, building, and machinery is still ongoing. Okay, Winbury Company was able to utilize. One more thing, they should have recorded the damage in inventory at the lower of cost or net realizable value. That means inventory is also overstated. So, in impairment expense, understated. Property, plant, and equipment, understated. Might be inventory as well, understated. Okay. Now, However, the claim for the warehouse building and the machine is still ongoing and was able to utilize the remaining four warehouses to provide coverage. Okay. Long-term borrowing comprises a bank loan taken out by Winbury Company, refund the joint venture with during the co-purchase of electric delivery vehicles. The bank issued the loan on the same term as the existing loan, which has a covenant that interest coverage maintained at 3. Let's see. Okay. Internet search. 3rd November, keeping up with demand, Winbury Company ahead in home delivery grocery revolution. The Grocery State Journal, Perishable Planet reports that demand for online grocery delivery has reached an all-time high, shows no sign of slowing down. The traditional supermarkets cannot keep up with the demand, leaving opportunities for gains in market share for online operators. Okay. 15 years week. Local residents to bring legal action against Winbury Company. Here they are showing good sign, but legal action again, that's a business risk as well as audit risk. Let's see. A group of 30 local residents who claim their health was affected by toxic fumes from the huge fire at Winbury Company Northern warehouse are taking action to claim for compensation. The local residents' legal representatives confirmed that they had served a claim against Winbury Company. There were health and safety breaches, which resulted in the sprinkler system failing to bring the under control quickly. Winbury Company Health and Safety Department has launched an investigation which concluded warehouse staff had manually overridden the automatic sprinkler system to prevent water damage to goods. Well, that's a business risk as well as all waste. Uh, if this is not resolved, it will lead to a bad reputation, fines, or penalties uh, to the Winbury Company. Okay, 18th of February, eco-friendly bans for delivery disruptions for Winbury Company. Again, that's a business risk as well as audit risk. A new fleet of 80 electric vehicles costing 50,000 each has caused delivery costs to Winbury Company local customers. The vehicles can travel for 100 miles without requiring recharging, which has left customers experiencing delays of up to 4 hours for their groceries. The eco-friendly brands were initially selected for purchase by management suitable has significantly reduced the distance and vans can travel on a single battery charge. And of question. Now on to the now the solution. Let's look at the solution now to do. The headings of the say audit engagement partner, firm, audit manager. The subject is audit planning in relation to Winbury Company date 1st July 2000X5. Okay. The briefing notes have been prepared to assist in planning the audit of Winbury Company. The notes begin with an evaluation of the significant business risks facing the company, continue with an evaluation and prioritization of the significant risk of material misstatement, which should be considered in planning the audit. Okay, the significant risk of material misstatement has been structured prioritize the risk in terms of the likelihood and magnitude of misstatement in relation to each risk. Right. The notes also include recommend principle of procedures which have been designed in respect of the investment in luxury pet supplies and the warehouse. Okay, assets following a recent fire. The notes consider the audit implications of a cybersecurity attack which took place during the year. Blah blah blah. Too early. We do not have so much time in the examinations, right? So what we have to write maximum 3 to 4 lines. This briefing notes includes evaluation of business risk, comma, evaluation and of risk of material misstatements. Going for, it also includes principal audit procedures. Okay, sorry. In respect of uh, luxury pet supplies, the warehouse also following a recent fire was finally considered cyber attack which took place during the year. That's it. 3 to 4 lines. That's it. Now, furthermore, but what we will write that for the purpose of these briefing notes, the overall of materiality assess the significance of identified risk is 4 million based on the profitability of the company as requested. Now, after that, you will provide the justification using the justification of the 4 million material. Okay, so using profit before tax of 3 million as a suggested benchmark result in a suggested range. Okay, 53 million into 5%, it's 2.65 million. You can see, and 53 million into 10%, that is 5.3. Therefore, this is it is an existing client, but it is a listed one. Changes in operations in the current year, which increases the risk. So that's why materiality should be set at the midpoint of the range, that is 3 million. Now, this is, it is a benchmark, is a starting point for determining material and professional judgment will need to be applied in determining a final level to be used during the course of the audit. So far, so good. Moving ahead, evaluation of significant business risks, damage to operation caused by the warehouse. In the end, we just identified it as well. So the fire has caused destruction of the warehouse servicing Winbury Company Northern customer base. Winbury Company will certainly incur higher cost to increase capacity at the existing warehouses and more significantly incur greater transport costs. See, these are the points which will score you marks. Alternate warehouse to supply this region. If there is disruption to services due to an interruption of grocery service, then this will cause a detrimental effect to Winbury Company reputation, which is likely to result in a fall in sales and profit. See how I'm connected? These are been connected. The damage to Winbury Company business could be amplified by the fact that online grocery deliveries are growing market and a failure to adequately service new customers to the sector could restrict this growth opportunity. International expansion. The expansion into far land introduces a business risk in that company uh, will be managing operations in a foreign country for the first time. Farland may have different laws and regulations compared to the company owned jurisdiction. So there is a heightened risk of non-compliance already identified. The types of groceries typically brought by customers in Farland may be different from Winbury Company home jurisdiction. Management may not have experience in their procurement, distribution, and sale. There are also risks associated with Winbury Company ability to set up an overseas distribution network, including the warehouse, delivery vehicles, suitably qualified staff to comply with foreign legislation. All of these issues create a risk that international expansion may not be successful. At the same time, will represent a drain on management time and resources. Okay, operations in the home country or Winbury Company may suffer as a result. So far, so good. We identified two business risks. Then we have investment in LPS company. The joint venture represents new method of expansion of Winbury Company and if they are unable to replicate their own high standards in the joint venture. Any quality issues with products or delivery problems with LPS company could have repercussions for Winbury company reputation, and this may consequently lead to a reduction in sales. There is also a possibility of a clash in management styles, techniques of two different partners in joint venture, leading to conflict which may affect business strategy, management focus, and consequently impact financial performance. Management may struggle to deal with the increased number of operations which they need to monitor and control. They may also focus on so much on ensuring the success of the new joint venture that existing activities are neglected. These issues heighten the risk of joint ventures failing to be successful and produce a satisfactory return on the 30 million initial investment. Okay. Then the loan finance. Wow. 125 million expansion into Fallen is to be funded by the finance, loan finance. The additional debt finance will increase Winbury gearing, and in a high, it is a high business risk. To ensure international expansion is successful, the interest bearing loan is covered without determining to the cash flow of the existing business. Winbury Company existing bank loans have the covenant that interest cover must remain above 3. The expansion additional purpose loan will therefore make it more difficult to maintain. And if the international expansion fails, Winbury is at the risk of defaulting on the bank loan covenant and bank recalling the loan. So, due to a recent joint venture, rapid growth in sales and planned expansion into Ireland is at risk from overtrading. The current management team may not be able to adequately control the high level of growth and may neglect Winbury Company's core business. This is particularly heightened as the home delivery grocery market is noted as experienced the level of growth and will attract strong competition. So, so far so good. We have looked at how much 2 marks for this one, 2 marks for this one, 4, 6, 8. Now we have to look at one more to get the maximum marks. So eco-friendly delivery vans, also a business risk. The eco-friendly delivery vans have been noted as causing delays of up to 4 hours, which will cause inconvenience to Winbury Company customers and reputational damage. It values the convenience of grocery delivery, and a 4-hour delay would survey negate this perceived benefit. Winbury Company would be likely to lose customers if the delivery delays continue, and therefore sales and profits would suffer, as well as the company having to bear the cost of an compensation or refunds which could be claimed by the customer for the delays to their deliveries. Officially done, but we will be looking at more legal. As I highlighted earlier, it's also a business case. A legal case is being brought against Winbury Company by local residents regarding the warehouse which was destroyed by the fire, and it is associated with toxic fumes, damage to public health. The result of the internet search demonstrates that the case is already reported in the public domain, and therefore some reputational damage is likely, thereby reducing sales and profits. This is also the business risk that the legal case will require defending or settlement, and therefore legal fees or compensation payment will be incurred. There is the further risk of having to pay damages, fines, if Winbury company is found liable of damaging public health through toxic fumes from the warehouse fire. The information provided regarding Winbury company staff circumventing safety controls increases the likelihood that Winbury company will be found negligent and possibly lose the legal case. And then one more cyber security attack. I already told you that it's a business risk as well. So, internet search, if accurate, states company has not fulfilled the requirement of data protection, corporate governance principles. This may result in reputational damage as well as possible requirement to pay fines or penalties, which both could result in cash outflows whether it is by cash payments or reduced sales. The risk of a fine or penalty is increased due to the fact that the directors of Winbury Company have not reported the breach of the regulator. The apparent concealment of the data breach by management not reporting the issue to regulators may also indicate a lack of integrity, lack of understanding by the management or of law and regulation. Or the team also consider the impact on the reliance on corporate governance matters concerning the business. So far, so good. We have one more perishable products. Nature of the Winbury's grocery delivery is the large proportion of inventory perishable, and there was a limited shelf life. The perishable nature of the goods means that any delays to delivery, such as those caused by the breakdowns of the eco-friendly vans, will have a greater impact to the profits of the Winbury company. If the goods were not perishable, this means that there is a significant risk of wastage and any inefficiency in storage or distribution will increase spoilage of inventory and result in loss of profit for Winbury. Additionally, the joint venture of LPS company will introduce a new range of perishable products which will have different storage requirements. So, five businesses were required. I discussed eight and giving extra. I have number two. Uh, see, if you look at the scenario carefully, line by line, every line will give you something, and that's the proof over here, right? Now, moving ahead, let's discuss the requirement B, evaluation of risk of material misstatement. Firstly, we have financial analysis. See, revenue is increasing by 66.8%, operating profit by 56.4%, and profit before tax by 71%, which are broadly consistent with each other. During the year, Winbury Company has new premium delivery pass revenue stream. This is not sufficient to explain the projected increase in revenue. Total assets are forecast to increase by 8.3, which may seem overly optimistic given a large warehouse being destroyed. Okay, Winbury Company is accounting for the assets of the new joint venture in LPS Company in their entirely by incorrectly consolidating LPS Company as subsidiary. There is a risk that assets are overstated. See how simple. Then warehouse fire. The most significant identified risk would be the assessment of the carrying amount of the fire damage warehouse, which is clearly above the materiality threshold of the 4 million. Damage to the warehouse should have triggered an impairment review as required by S36. However, the finance director has wrongly assumed that the fire insurance cover on the warehouse release Winbury Company of the requirement to property assess the impairment of the warehouse and perform the calculation in accordance with IS 36. Impairment is measured by comparing the carrying amount of asset with its recoverable amount. The recoverable amount is the higher of value and fair value less cost to sell. The significance of the wear of fire is not simply a quantitative one, but also an indicator of potential management bias and impact of their judgment on the finance. The risk of material misstatement regarding this issue are therefore high significance to the audit team. As the warehouse has been destroyed by the fire, it is likely that value in use is nil and fair value as to sell would have been considered in its current condition. Warehouse is badly damaged and the machinery needs to be completely replaced. According to IS 36 cash flow projections, which are used to determine the value and use of the impaired asset, should relate to assets in its current condition. Expenditures to improve or enhance the asset performance should not be anticipated. The finance director has not carried out an impairment review. And as he is confident the company's insurance policy will cover the cost of reinstated it to its previous condition. And this is against the criteria of IS 36. And there is a risk that property, plant, and equipment is overstated and impairment cost is understated. In addition, it is important that any amount claimed through the insurance policy is recognized separately from warehouse PPE. The current status of insurance claim must be verified during the audit process and, if necessary, prior to the completion of the audit. This will determine to what extent the warehouse should be impaired in the financial statements. Investment in LPS. The finance information shows LPS company revenue is projected to reach 10 million this year. The investment is expected to occur in August X5. So based on this, projection 10 million revenues for a maximum of 2 months, which is clearly above the determined material. Winbury company is also recognizing total assets of the joint venture of 60 million. So far, so good. LPS company. See, I, uh, I'll be taking 2 marks for it. Okay. Now the sixth, investment in LPS company. The financial statement shows that LPS company's revenue to reach 10 million this year, and the finance investment is expected to occur in August X5. Yes. So based on this projection, 10 million revenues for a maximum of 2 months, which is clearly above the determined materiality threshold. Winbury company is also recognizing the total assets of the joint venture of 60 million, which is also in excess of materiality threshold. And from the management extracts, it seems that investment is a joint venture with control of LPS company shared between Winbury company and Durian company. IFRS 11 joint venture arrangements defines joint venture as a joint arrangement whereby the parties who have joint control of the arrangement have rights to the net assets of the agreement. Now, IFRS 11 requires that a joint venture recognize its interest in a joint venture as an investment and shall account for the investment using the equity method in accordance with IS 28 in associates and joint ventures. The finance director has stated that he intends to consolidate the results of LPS company with a share of the results attributable to Durian company being shown as a non-controlling interest. The finance director believes, despite Winbury company and Durian company each owning 50% of LPS company, and having equal representation on the board of directors. Winbury Company contributing of knowledge to the joint venture is greater, and therefore Winbury should consolidate investment as subsidiary. Okay, this treatment is contrary to the IFRS 11, whereby the control is considered to be joint if the investors in the venture have equal shareholdings and equal representation on the board of directors. See, there is no evidence that Winbury Company holds the right to veto decisions, which is a possible way the finance directors could justify Winbury Company holds overall control and would be entitled to consolidate LPS Company. The impact of the full consolidation of LPS by Winbury Company as a subsidiary would not have a net effect of the overstating Winbury Company retained profits or net assets. This is because the non-controlling interest of Durin Company would be represented on the statement of profit or loss and statement of financial position. The attributable profit and equity of non-controlling interest belonging to Durin Company would be shown in the proportion agreed to 50%. However, the gross total of the assets in Winbury Company statement of financial position or statement of profit and loss would be inflated by LPS being incorrectly consolidated as subsidiary undertaking. See, so the consolidation of the full results of LPS scope would, however, increase Winbury Company revenue, operating profit, and total assets, which may be the motivation for the finance director to claim that Winbury Company controls LPS and is entitled to fully consolidate the results. Well, that has so much issues in it, so we'll be getting 3 marks for it. No, okay. Now the revenue one. There is a risk that Winbury Company recognize revenue for customers in advance of the satisfaction of the performance obligation for the annual premium delivery. When the invoice is sent to the customer, this is leading to an early recognition of revenue, that is company providing a service contract with customers requires that revenue is recognized when performance obligation is settled by transferring a promised good or service to a customer. As a premium delivery pass covers 12 months and the company is providing the service over time, it can be difficult to determine how much service has been provided and therefore amount of revenue which can be recognized at a particular point in time. So it does not appear that requirement of 515 are adhered, and there is a risk revenue Winbury Company also has a further revenue recognition risk that revenue from the orders is recognized at the point of order rather than at the time of delivery, as previously stated. IFRS 15 states revenue is recognized when performance obligation is satisfied, and in Winbury case, this would have been the goods are delivered to the customer. There is a risk that revenue is being overstated, deferred income is understated. Again, corporate governance. The recent cybersecurity attack highlight that internal controls are deficient within the company. Even though this particular problem has not been rectified, if Winbury Company had not properly identified or responded to this cybersecurity risk, these remains the possibility that there could be other areas which are deficient, leading to control risk. The issue also indicates that audit committee is not appropriately fulfilling its responsibilities with regards to internal audit, which could indicate wider weakness in the company corporate governance arrangement and results in increasing risk of material misstatements. So, legal provision. So far, the Inbury company in January X5 from the information provided, it is not possible to determine if the amount involved is material. However, there should be appropriate consideration as to whether the court can give rise to an obligation at the reporting date or not. According to IS 37, provisions, contingent liabilities and assets. As a provision should be recognized as a liability if there is a present obligation as a result of past event, which give rise to a probable outflow of economic benefit, which can be reliably measured. The warehouse fire is a known event, so if there has been harm to people in the local areas as a result of this, then it is feasible that there is a liability as a result of past event. As a risk of material misstatement, therefore, arises that if any and in to the state, there is a risk of inadequate disclosure. There is a risk whether the situation gave rise to a provision or a contingent liability. Provision also have disclosure requirements which may not be complied with. A further risk is that uh, legal fees as associated with the claim has not been accrued within the financial statement. As the claim has arising during the year, the expense must be included in this year profit or loss account, even if the claim is still ongoing at the year end. The fact that discussed at the meeting with the audit partner may cast doubt on the overall integrity of the management and on the credibility of the financial statements. Management representation should be approached with a degree of professional skepticism during the audit. Pressure on results. The company's listed entity, shareholders, see here for what to do. Pressure on results. So far, we have got 12 to 13 marks, right? We still 4 marks short. The company is a listed entity, and the shareholders will be looking for a return on their investment in the form of a dividend payment. Will be pressure for the company to show good financial performance. This is compounded by the company's ambitious international plans and the requirement to maintain adequate interest cover to continue to meet the bank covenants. Pressure to retain a better performance create an incentive for management bias, which means management may use earning management techniques or other methods. This creates an inherent risk of material misstatement. Level management bias should also have led to some of the minor characters, such as the early recognition of revenue from the premium delivery pass, etc. Okay, which improve the company profit total assets for the year. Now, uh, eco-friendly delivery vans noted in the inherent internet material vans are impaired as the ability to vans to make deliveries in line with the Winbury company deliveries appears to be reduced. Impairment is measured by comparing the carrying amount of asset with its recoverable amount. The recoverable amount is the higher of value in use and fair value less cost. Still, there is a risk that value in use is lower due to the reduced ability of the eco-friendly vans to the delivery goods efficiently and effectively. The fair value of cost of sale of assets may also be impacted by the delivery range of vans. There is a risk carrying amount of PPE of the eco-friendly van is overstated and impairment expenses understated. All done. In the end, we have to give the conclusion. The risk of material misstatement have been ordered with the regard to the estimated magnitude of the misstatement and likely of such misstatement occurring. For example, warehouse fire, highest quantitative area, which is deemed to be a risk of material misstatement newly occurring in the year, and there is a significant risk of management bias in measuring of the impairment. Similarly, joint venture with during company is quantitatively material and fundamental change in both operations according to Winbury. In contrast, eco-friendly delivery vans are borderline to the stated thresholds of materiality, therefore at lower risk of material misstatement than the other risk as outlined above. Finally, the conclusion where Windsor Company has a significant number of audit and business risks, which could result in material statement in the financial statement. Quinseco should reassess their assessed level of planning materiality to ensure the risk profile of the company adequately reflected in level of testing planned. The audit should be planned to assign high competent staff for the high risk judgmental areas. Now let's discuss the requirement audit procedures. Obtain the legal documentation supporting the investment and agrees the details of the investment include rights and obligation of the investment properties to understand the implication for the reporting by Winbury Company in the financial statement, date of investment, number of share purchase, and reporting rights attached to the shares, and understanding the control of the venture, the nature of the profit sharing agreements, the nature of the assets of the LPS company assets, contract and the communication with the auditors, confirmation there is no restriction of the company share controls, review board minutes to understand the business rationale of the investment, and to assess the amount of control existence of joint control, review minutes of the relevant meetings between the company and during the company, to confirm control is shared between the two investors and to understand the nature of the relationship and decision making process, obtain documentation of such as LPS company organization structure to confirm the company has successfully appointed members to the board of company and that those members have equal power to members appointed by company. Finally, the last requirement of the question. Auditor's responsibilities in relation to an audit client compliance with laws and regulations. Winbury Company appears to be in breach of relevant laws and regulations regarding the protection of customer data, consideration of laws and regulation, audit of financial statements. State there, while it is management responsibility to ensure entities' operations are concluded accordance with the provisions of laws and regulations, the auditor is responsible for obtaining sufficient and appropriate audit evidence regarding compliance with laws and regulations. Auditors need to assess the evidence, especially where non-compliance has an impact on the financial statement or where any non-compliance will affect the entity's ability to continue its operations. The auditor is required by IS 350 identifying and assessing the risk of material misstatement to gain an understanding of the legal and the regulatory framework in which audited entity operates. This will help the auditor to identify non-compliance and assess the implication of non-compliance. Therefore, auditors should ensure they have a full knowledge, understanding of the data protection regulations in order to evaluate implication of non-compliance. Company ISA 250 requires when non-compliance is identified or suspected, the auditor shall obtain an understanding of the nature of the act and the circumstances in which it has occurred. Further information to evaluate possible effect on the financial statement. Procedures must be performed to obtain evidence. Okay, evidence, legal and operational consequences of the breach, including likely fines and exposure to litigation assess, materiality of such exposure, as Winbury Company has not yet notified the regular or the affected users. Queens and Co should initially encourage directors to report the issue themselves before making a disclosure they deem are required under the auditor's obligations described above. Auditors should comply with the fundamental principle of confidentiality, and if disclosures were to be made by the auditor, it would be advisable to seek legal advice. Finally, uh, in exceptional circumstances where the auditor believes there may be an imminent breach of law or regulation, they may need to disclose the matter immediately to an appropriate authority. Decision to disclose will be a matter for the auditor's judgment, and where the disclosure is made in good faith, it will not constitute breach of the duty of confidentiality. So far, so good. I hope you understand it. See you in another class.